I told you that a variance is what? The difference between what? Standard and
The
what? Actual, right?
actual.
So that means that anytime there's a difference, is between what? Standard and actual. That's the rule. So it means that I gave you the various quantity. Remember that variances can be a difference in quantity or a difference in price, right? Because value is equal to what? Quantity and price. No, so quantity by price. So it could be that quantity A was different from quantity B, right? So standard and actual quantity. And it could be that there was a difference between your standard price and then your actual price. Makes sense? So this is what we are finding. So sales, the quantity variance for sales is called volume. I explained to you the last time. And the quantity and the price variance for sales is called price. No, be so good. Now, if I say sales volume variance, that means the difference between actual volume and then what standard volume. And volume, because it's in total, is mostly called budgeted, but you can still use standard because of the explanation, they understand it. So it means that, okay, now that means that sales volume is the difference between volume. Volume is quantity, you know that, right? So you are saying that this may be what the difference between what your actual quantity minus what your standard quantity, which is your budgeted quantity anyway, because quantity is always in total, right? So your actual quantity minus your standard quantity, all at what? All by what? Standard. Standard profit. Remember, not price. Profit. I told you volume depends. So sales moves with profit. If you are dealing with volume, meboa dodoɔ a wobɛtɔ ngyina mfa so a wopɛ so. True or false? So sales volume, dodoɔ, the sales quantity you always want to sell depends on your profit margin, not the price. You get? Is it clear? So you always take your actual quantity minus your standard price. I said standard price, actual quantity minus standard quantity or your budgeted quantity, all at your standard profit. Quantity, remember, that's why the volume variance, when we're doing mix and sales quantity, we multiplied all by standard profit because standard profit is the common factor here. You get it? Okay. So we come to price. Price is the difference in price. Okay. So all you have to say is, okay, this one is my actual price minus what? My standard price, all at what? My actual quantity sold. Because here we are looking at the difference in price. Okay. All at what? Your actual quantity sold, because you can't use budgeted quantity because this is actually what happened. So it will be better to compare all at this actual quantity. Okay. So this is the only variance I'm going to go this way. The rest, I'm going to show you a way to generate the method you are going to use, and it will be similar across all of them. All right. So using this one, I hope this one you won't forget. I hope you won't forget.
Sure.
All right. So using what we have here, let's get our figures. Okay. So I have co. Why is this thing messing up? I have co. I have two, and I have ka. Right. Based on the question we have. So in that case, our actual quantity for co was what? 30,000. No, be so. Then standard quantity was what? 36,000. Is that not so? All are the standard profit. This guy's standard profit was 7. Do you guys remember? Then this guy, you are just taking top minus bottom. Hey, bottom minus top, right? The actual is down there. Bottom minus top. Because you are doing actual minus. So the actual was what? 35,000, right? For cool. Actual quantity minus the standard quantity at the top, which was 27 what? 1,000. All at what? The standard profit was 6. Do you guys remember? Then this one, it was what? 25,000. And that was what? 18,000. All at what? 5, right? So that gives us our sales volume variance. That's all. So we have our 30,000 minus 36,000, all at 7. And that gives us what? 42,000 adverse. Also, we have 35,000 minus 27,000, all at 6, and that gives us 48,000 favorable. Then we have 25,000 going by 18,000, all at 5, and that gives us 35,000 again, favorable. If we put all together, we get the total volume variance. Okay, and 42,000 adverse, 48,000 favorable, 35,000 favorable. You end up with 41,000 favorable. Check whether the sales quantity plus the sales mix, did they give us 41,000?
Yes, 41,000 favorable.
Yes, 41,000 favorable. You see, it adds up. That is it. Is this thing difficult? So that's our sales volume variance. Now we go to sales price. With sales price variance, it's just the difference in price. So co, to, and then ka, right? So all we have to do is compare the prices, okay? So how then do you get each of the price? So you can see that they didn't give us the price for the actual sales, right? But we know that some number of units were multiplied by 30,000 to get 420, right? Can you all see? Some number of units were
Yes.
multiplied by 30,000 to get 420. Some were multiplied to get 367. Another number of units were multiplied to get 325. Not so. So all you have to do is just divide, and what do you get? That becomes our actual price.
Koi is 14.
There is 14 CD, right? So 14
So,
CD.
Yes,
Paul,
please.
Yes, please.
in getting the actual selling price in exam condition, do you still need to show working so you can just crash your calculator?
You can just crash it on your calculator. Don't worry about that one.
Okay.
So 14 by 15 by the actual quantity sold was what? That was 30,000 units, right? Then this one, we sold 367,500. We just divide by 35,000 units. And that is what? 10.5. Meboa.
Yeah, 10.5.
10. We subtract 10 from it. All at what? 35,000 units.
There.
Awesome. And this one, it was 325,000 divided by 25,000 units. That's 13. This one was 13 CD. But then the standard was 12.5 at the top there, right? 12.5. All at actually 25,000 units were sold. So that is it. So this adverse 30,000. This one is 10.5 minus 10. 17,500 favorable. This one is 13 minus 12.5. All at 25,000. That gives us 12,500 favorable. So our total price variance will be what? 30,000, 17,500, 12,500.
Zero.
Zero. That means there was no variation in price. Okay. All right. So this is how we do sales variances. Any question? Any question? So can we move to cost variances?
Yes, sir.
Yes, please.
Okay. So when it comes to cost variances, I already told you that whatever you know, throw it away. Okay. So when you want to know, we know variances is standard minus what? Standard minus what? When it comes to cost, it's standard minus what?
Actual.
Actual. And we know standard can be a quantity or it can be a what? A price. Meboa. No be so.
Yeah.
Actual
Yes.
too can be a quantity and it can also be what? A price.
Right.
No be so. So if you are doing variance, when standard changes, it must automatically become what? No, we are looking at the change. So when standard changes, it must become what? I said variance is the difference between
Actual.
standard and actual. So when standard changes, it must become what?
Actual.
Actual. No, see, I said it's between standard and actual. Into standard system, I was said then.
Actual.
Actual. We are comparing
Actual.
an actual. So if it is not standard, then it is what?
Actual.
Actual.
Then it is actual. That is all I'm saying. So I want to, you are going to develop a pro forma in so that you don't think in exam. So because we always stand with standard, remember we are getting a value, right? Which is quantity by price. So you always start this value with your standard quantity and standard what? Price. Are you following? Are you following?
Yes, sir.
Yes, please.
Now you go this way. When standard changes, it must become what?
Actual.
Actual.
Actual. So you bring actual quantity, then you maintain the standard price. Then you go this way too. When standard changes, it must become what?
Actual.
Actual. So here becomes actual price, then you maintain the actual quantity here. So when you look here, price and price are the same. Are you getting it? But the variance is between quantity and quantity. Meboa. So here, if this is material, this is the usage variance, or this is simply the quantity variance. Okay, this is simply the quantity variance. And when you come here, where is the difference? Quantity and quantity are the same. Meboa. Where is the variance coming from?
The
Price.
price.
It's coming from the price. So here the variance is the price variance. If you think this one is not okay for you, still do this pro forma and say, okay, SP is the only one which is common. Meboa, they are the same. So let me factor it out. This means that you are doing what? SQ times SP. Are you following? It's always top minus bottom. You are literally doing SQ by SP minus AQ times what? SP, right?
SP.
And that is what gave you the quantity we are seeing here. Does it make sense? If you don't like it this way, then the common factor here is SP. Factor it out. So if SP comes out, you are left with what? SQ minus AQ, right? Makes sense. Which gives you the quantity variance. If you come here too, it is what? AQ by SP minus what? AQ by AP. But then this gave you what? Price.
Price.
If you don't want it this way, what's the common factor between them?
AQ.
AQ.
Right? So you can decide to bring AQ out and have what? SP,
Yes.
AP. And that gives you your price variance. It's up to you. Any way you go should still give you the same thing. Right? So let's build a pro forma again. I said we always start with what? Value is quantity times price, right? So we always start with what? Standard quantity by what?
Standard price.
Now, when standard changes, it becomes what? You change quantity first. So when standard changes, it becomes what?
Actual.
Actual.
Price.
This becomes actual price by, then you maintain the standard quantity. This becomes actual price. Then you bring what? Your actual what? I said actual. Becomes actual quantity. So we bring the actual quantity here. Between this and this is what? Is the quantity variance. And between this and this is what? The price what? Variance. That is it. So you go this way. When standard changes, it becomes actual. You maintain this side. It changes again. You change this side, right? You maintain the other side. It's just like that. Does it make sense?
Yeah.
If you want the formula, then summarize it. It's always this minus this and this minus this. Then you can put it in formula if you like formula, but I don't like formula. So I just go straight forward and then I use it, right? So we will develop the pro forma for material, labor, and the rest. So when it comes to materials, we know materials, the same thing. If we want material cost, it's definitely material what? Material quantity by material what? Material price. Meboa. No be so?
Yes.
So since it's material quantity by material price, then definitely there will be a change in quantity. Quantity can be standard quantity or it can be standard price. Here, price can be standard price. So why am I saying standard quantity or standard price? I'm dealing with quantity here. So it may be standard quantity or what? Actual quantity, no be so. And this one may be standard price or actual price. True or false? Don't know why this thing has started messing up. Standard price or what? Actual price. So what we are saying is that we lay out our pro forma, right? Material cost variance. So we say, well, standard quantity times what? Standard price. Actual quantity times what? Standard price. You understand how I got this, right? When this changes, it becomes actual. You maintain this side. I have actual price, actual quantity. Meboa. Makes sense now. So between this and this minus this, we get the usage variance, which is the quantity for material. And between this and this, we get what? The price variance. Does it make sense?
Well, put your comment in.
What's it?
Comment in. Please start from the material cost.
This is it.
No, I'm okay with it, but the next one, the one we are just treating, the material and the material
No, is it not the
cost
same
variance?
approach here? Standard quantity, standard price, actual quantity, actual price. No, so actual quantity, standard price, actual quantity, actual price. I told you between the first and the second, the difference is in what? The quantity, not the price. So it's the quantity variance. Here and here, the difference is what? In what? The price, the quantity remains the same. So it's price variance. Let's come to material. When you come here, this and this, are they not the same?
Yeah.
So where is the difference coming from? Is it not quantity and quantity? So it's a quantity variance for material. Your friend usage. Over here, quantity, are they not the same? Are they
Yeah.
not the same? So where is the difference coming from between price and price? So the price, the variance or the difference is in the price. So it's a price difference, which is price variance. Makes sense. So assuming this one you got XA and this one you got XB and this one you got XC, you are saying the usage variance is XA minus XB, and that gives you what? The variance. And here you are saying the price variance is just taking your XB minus the XC, and that gives you the variance. Okay, variance A, variance B. If you add these two together, then this should give you the total material cost variance, which is what? Variance A plus variance B. That is it. Is it clear? Saying it's like it doesn't make sense, right? Unless we take a question. Anna?
We are seeing the picture.
Okay. So let me see if I can get a variance question. Okay. So look at this. Ponty Limited, can you see? Ponty Limited uses a standard costing system and the standard cost card for one product. I hope you can all see. For one product is shown below, right? You can see all this, the standard, and then you can see the budgeted production, you can see the actual. This is the actual. Then they said we should calculate all possible what? Variances. Can you see that? Calculate what? Calculate what? All possible variances. No be so. So what's the first thing we do? I want us to go and get what? Our good friend, the sales variance. Mokai. You remember sales variance?
Yeah.
Okay, so We first have what? Sales variance. We know it's broken into what? Two. What are they? Sales what? Sales
Volume and price.
Price, volume and price.
and then sales what? Sales price.
Price.
So here the difference is between the quantity. Volume is quantity, right? So the difference is between what? The quantity. So this becomes our actual quantity. Always sales, you start with actual. Actual quantity minus what? Our standard or budgeted quantity. Or by what? Or by what?
Standard profit.
Standard
Standard
profit.
Yeah.
Because sales depends, volume of sales depends on your profit. Dodo albeton agent on fast also, right? Then this one, we know that is between what? Our actual price minus what? Our standard price, all at what? Our actual quantity sold, right? So once we lay this down, let's go and see if we can get the information. First of all, let's get our actual quantity. What was our actual quantity? So we go to the actual information. What did they say? They said budgeted output and sales was 500 units. No, so. But then actual production and sales for the period was what? Was what?
600.
That means we actually
600.
600, right? But we were expecting to sell how much?
500.
We were expecting to sell 500. Budgeted output and sales, right? 500. Thank you. That means there wasn't any opening stock and closing stock. That means whatever we expected to produce was what we expected to sell. But what if they told you that budgeted production was 700, but budgeted sales was 500? What are they saying?
There's a normal.
700. No, you produced 700, but you sold 500. It's not normal loss. It is what? Oh yeah, 7, but what on 5?
Closing stock.
Closing stock of 200. That means you left some goods behind. Actually, sales for the period was 600, but you produced 400. What does that tell us? There were additional, there was opening stock, right? That means there was opening stock of 200. Do you get it? Check. During the period, you only produced 400, but they are telling you that you sold 600. Where did you get the extra 200 to add up to the 400 you produced to sell 600? That means there was opening stock. You see how this thing works? Do you get it?
Yes.
Are you sure you all get it?
Yeah.
Yeah.
If you don't get, you draw my attention. Always, when there's a variation between production and sale, it's either opening stock or closing stock. Makes sense? Please have it here. It's very important. But here, they said production and sale are the same. That means whatever you produce is exactly what you sold. So if whatever you produce is exactly what you sold, that means there's no closing and opening stock. Clear? So we expected to sell 500, but we sold 600. All our standard profit. What was our standard profit? Standard profit margin. It was what?
10.
10. It was already given, right? So what are they using? Are they using absorption or marginal costing?
Absorption.
Absorption, because there was fixed overhead per unit, right? That's what should tell you that they are doing absorption. So in that case, this one by the 10, what do we have? We have 1,000 what? Favorable. Not so. Not be so. Let's come here.
Yes.
What's the actual price? Give me the actual price. So you go to the actuals. This is where we find the actuals. So actual price you're saying. Please, we have less time. Oh. Check. Always they give you the data. Where do you see price? Sales. Is there how many units were sold?
28,800.
No, I said how many units were sold. Please read the question well.
600 units.
Were sold at what?
28,000.
No.
Sold and had
600 units were sold at what? At 48 cedis per unit.
Okay.
For the sales revenue. Please, you need to pay attention. Exactly. So in that case, this becomes what? 600. I get I said 600. The price, we sold it at what? 48, right? But when you look at our budgeted sheet, what was our selling price? It was what?
50.
50. So we sold at 48, but this one we expected to sell it at 50. But how many units did we actually sell? Is it not 600?
600.
Yes. So this gives us our sales price variance. So
1,200 adverse.
adverse, right? 1,200 what? Adverse. Thank you. Okay, so usually they'll tell you to reconcile your budgeted and actual profit. Okay, so at your level, you don't just get variance rate. Sometimes, if you are lucky, I taught you how to do this in our first lecture. So, with a reconciliation statement, how do we do it? What did I tell you the last time? What did I tell you the last time?
The budgeted profits.
Adjusted by.
Look for the budgeted profit first.
So we bring our favorable variances, bring our adverse variances, right?
Adverse.
More
Yeah.
So we add
Yeah.
all favorable variances, less all adverse variances. So you mostly start with what? Your budgeted profit. Okay. So here, the budgeted profit was not given, but we know that what? We had a profit of what? 10 cedis per unit, but we're expecting to what? Produce 500 units. True or false?
Mm.
500.
True.
Our budgeted profit should have been what? 5,000. Not so. And our actual profit, they would have given it. That means you have to work this out, right? But don't worry. When we finish, we'll work the actual profit to see if it will balance. Okay. So now all we have to do is that once you've done budgeted profit, once you get the variance, I'm just showing you a shortcut. Then you come and say what? Variances, right? What variances have we got so far? Sales what? Sales volume.
Those-
Sales volume, we got positive 1,000, right? What about sales price? Sales price, we had what? 1,200 adverse. Mebwa. So that one,
Yeah.
1,200 negative. Okay. You see? Or I can put it in bracket like this. Okay. Good. So now that we are done with sales, the next thing we need is what? Cost variances, right? So I told you cost variances, we always what? Do standard minus actual. You remember? That's why mix and yield, you see standard was starting before actual. So for cost, just so we don't have to think about adverse or favorable. So we say standard minus what? Actual, right? So cost variances. Let's start with material. So we need material cost variance. Please pay attention here. So now we know that we need quantity times what? Price. Mebwa. Good. So in that case, let's start. We always start with standard quantity, standard price. Is that not what I taught you? Is that not what I taught you?
Yes, sir.
Then this one must change. It becomes what? Actual quantity at what? At standard price. Mebwa. Then this one, so you go this way, then you go this way, right? Then this one becomes what? Actual quantity times what? Actual price. Okay, good. So here, all you do is copy and paste. What did I say? All you do is what?
Copy and paste.
Copy and paste.
Yeah, please.
Material, standard quantity, you're saying, come to direct material. Standard quantity, now you're saying
2.
2, right? So you just put your 2 liters there. Standard price was what?
5.
$5. No, be so you put it there. The reason why you see I'm leaving space here is because standard quantity is always of actual production. Mokai, we've done this several times. So by now, everybody should know. Do you guys remember that I told you that anytime you hear standard quantity, we always multiply by actual units produced? Mokai,
Yes, sir.
what you are doing is you are flexing. Standard is always at actual units. If it is budgeted quantity, that means you take the standard quantity per unit and multiply by the budget unit. But if you want standard, you multiply by actual. We did this several times, right? No problem. Actual quantity produced was what? Actual quantity for material. So you come to actual data. What was the actual quantity for material? How many liters?
1, 2,
50.
1,
1250.
1250. So we just come and dump our 1250 liters here, right? Good. Okay. Now what was standard price? Standard price was also $5 what? $5. Okay, so I just dump it there. Now we are saying actual quantity at actual what? Price. Now, do you know this actual quantity at actual price is actually the actual cost? You guys get it? Now, material, we spend 1,250, costing 6,700. So 1,250 times some price gave us 6,700. Meboa. True or false?
True.
So that was the actual quantity at actual price, and straightforward, they gave us how much? How much did they cost? Is it not 6,700? Is it not 6,700? So you're saying 1,250 times some actual price. I get it. There's no need about getting the actual price. We don't really need it. So 1,250 times some actual price is what ended up giving us this 6,700. That's what is there. So if you want the actual price, you can divide 6,700 by 1,250. You come and get this actual price. But here we don't need it. But anyway, you can do it, just to be fair. So now that we've done this, you realize that when we multiply this and this, what do we get? 1,250 divided by 2, you're saying 625. Okay. But when you come here, you see these figures are in the 6 categories, 6, 7, 6, 250. But this one, when you multiply, it's just 10. That means something is missing. What is missing? Actual units produced. What was the actual units that were produced?
600.
600, right? Now, literally, if you multiply this, you see it will start making sense. 2, 6, that's about 1,002, right? This is what it means. Those who use the old variance approach, they are saying that we should have produced 1,002. We should have used 1,200 materials, but we did use 1,250, right? So did we use more or less? Yaboka na yenya mfaso. Yaboka. But here you don't have to think. This approach, you just calculate, right? So 1,002 by this 5, that gives us what? 12 divided by 2. That's 6, right? That gives us 6,000. Okay. So that is all. So now you are getting your usage variance, and here you are getting your price what? Variance. So how do I get usage? It's 6,000 minus what? Minus 6,250. It's just this minus this. And here too, how do I get price? It's just what? 6,250 minus 6,700. That's all. So what's the variance? That becomes your total material cost variance. Here you don't think. So you just do 6,000 minus 6,250, and that's 250 adverse. And here you do 6,250 minus 6,700. That's 450 adverse, right? So at the end of the day, you have what? 700 adverse variance for material. If you want total variance straight, I can jump straight from here to here. And if you check 6,000, this is the same as taking what? The first one minus the last one. I can jump to anywhere. That's 6,000 minus what? 6,700. And that straightforward gives me what? The total variance, 700 adverse. Do you get this?
Yes, sir.
Who doesn't get it? Who doesn't get it? Okay.
Prof, I don't get it.
Let's do labor. It will start making sense. Okay. So let's go to labor. So labor variance. Labor variance, the same way we start with standard. Labor doesn't use quantity. Its quantity is hours, right? So we say
Hello,
standard
sir.
hours times standard rate. No be so?
Hello, sir.
Yes, please. Actual hours times standard rate and actual hours times actual rate. Please, I'm listening.
All right. So when we're doing the sales variance, we made mention of the opening inventory and then the closing inventory. So in a case where those, how are we going?
Don't worry, we'll get there. For now, I just want you to get the basics. If you
All
understand
right.
the basics, me switching in inventory won't be a
So
problem. Is that okay? You only adjust inventory
Okay.
not when you are
Okay.
calculating the variances, okay? You may have closing and opening inventory,
Okay.
the material variance. But ENT basics now here. I will introduce inventory. First, let's get the basics without inventory. Then I'll make you understand, right? Okay. For now, do you understand this format? Isaac,
All right. All
format.
right.
All right.
Prof,
Yes.
yeah, I get this format now.
Okay. Into TABBO. If you compare top and bottom, where is the difference coming from among these two that you have here? Isaac, give it to me. Where is the difference coming from? Is it coming from
It
S?
is coming
It's coming from the hour.
it's coming from the hours.
So that means the variance we will get here is an hour variance, and hours you use depends on how efficient you are. Meboa. So this is a
Yes.
variance. When you come here and here, what do we have? The difference is in
Rates.
the rate. That means this is the rate variance. Does it make sense? That's all. See, now we do pick and act. What's the standard hour? Go to direct labor. Standard. We just pick. That's all. Now you get the flow, right? Direct labor. How many hours standard was used? Is it not 2 hours? I just picked 2
2
hours.
hours.
Standard rate was what?
6.
Standard rate,
$6,
$6.
right? So I just put my $6 there. Actual quantity at actual rate, which is the actual cost of labor. Now you're saying we spent what? 6,000 what? 100.
100.
Okay, which is the total, right? Okay, actual hours that were used were what? Let's go to labor. Actual hours used was what?
1,100.
1,001, right? So you just come and dump what? Your 1,100 here. No be so. That's all. This 1,100, they multiply by some actual price to come and get this 6,1. Matthias here. But are you okay now?
Yes, but I get that one.
So 2 hours where we must always multiply by actual units produced, and we actually produce 600 units. Mokai. So always the SK, SH, whatever is here, the standard is always of actual production. Okay, clear? So you see we are multiplying by 600 again. Let's go and check the material. You see we also multiply that one by 600. Makes sense. So always you multiply whatever you have here by the actual unit that were produced. So that is all.
Why are we not using the 500? That's the budget, but rather you are using the
if you multiply by 500, it becomes budgeted hours. Remember, I told you standard per unit is the budget in per unit form. So if you multiply by the actual, you are getting standard. This thing we played around with it the very first day and even yesterday. I told you so far as you have standard is the budget per unit. If you multiply by actual unit produced, you get standard. If you multiply by budgeted unit produced, you get budget. Man, waha. I did. And we even prepared a flex budget. When we were preparing the flex budget to compare and get a variance, did you multiply by the fixed budget unit or you multiply by the actual production unit? Which one? But for the question
The
is for
actual.
you.
Prof,
But for the question is for you.
Then now you prepare flex budget na menene kata. Then you're stable.
One share video no. See, this thing just understand the concept. Standard is a per unit of the budget. If you multiply it by the budgeted unit, you get budgeted, okay, units. Do you understand? You get the budgeted hours. But if you multiply by the actual hours, remember we are comparing actual hours against actual hours. There must be a common factor so that the hours will be the different. But if this one is at, look at this, 2 hours, BB, by 500 budgeted hours. Look at this. And then what? Here would have been what? 1,100 hours. Okay, which is actual hours. Now you realize that assuming we multiply these 2 and the 5, Prana, we are only getting budgeted hours. So how can we compare? Because this is actual hour. It must be actual hour against actual hour so that we can compare the difference in hours. Does it make sense? It's like saying that, oh, I work in MTN. I'm what? an accountant, and you work in marketing, you are working in Vodafone, we can't compare because there's no common factor. But if you are working in MTN and you are an accountant, and I'm also working in Vodafone and I'm an accountant, then we have a common factor, which is accountancy. We can use it to compare. Do you get it? So always, we must have the same base. So here, we are multiplying at the actual units. This one too was some actual hours multiplied by some actual units. The same 600. It was something by 600. Divide the 1,001 by 600. Let's see. How much do you get? How much do you get? 1,001 divided by 600.
1.83.
Okay, that means they use 1.83 hours by the 600 units. That's what got us this. So because this is 2 hours, this is 1.83, the 600 must be the common factor. Does it make sense? If you put 500 here, you cannot compare because that is at 500. That's a different unit. So standard is always of actual production. Is it clear? Please, if you get this wrong, your whole variance will be wrong. Oh. You only get this rate.
Okay, I get it.
Whether you are using formula or you are using this, is the same thing. Let's see. So you are literally saying that what? Standard hour by standard rate minus what? Actual hour by standard rate is efficiency, right? This is the same as standard hour. Standard rate coming out. Standard hour minus what? Actual hour. Is that not so? This is what you have. Now, standard rate, we know this was what? 6. No be so. Standard hour, what is it? When you check, it's 2 hours. But these 2 hours, you have to multiply by the actual units produced, right? Before you can now subtract the actual hour, which was 1,100. So that means this one gives you 1,002 minus 1,001. Are you getting it? Before you multiply this by the $6, then you come and get the variance. It's the same thing we are doing, just that we have expanded the bracket and we are doing it simply. Do you get it? Please, no one here should forget it. Otherwise, you mix the most important maths. Efficiency is very important because this thing, they always check it. Variance. Even yesterday when we're doing the mix and yield, the very first question where we use the Milo and the T, you see that the actual units that we produce, we went to multiply the standard units by that. True or false? True or false?
True.
True. So that tells you the standard is always of actual production. So why did we go and multiply by the actual units produced? Because standard is always of actual production. It should be in your head. Unless when you want to get budgeted, then you multiply the standard per unit by the budget unit to get the budgeted hours that were used. When you get to fixed overhead, you will understand. But for now, are we okay? So this one gives us 1,200. It means that literally 1,200 units or 1,200 hours were used, but we're expected to use 1,000. We're expected to use 1,002, but we use 1,001. Yenyam faso anayaboka. That is what we are talking about, right? So in that case, give me the figures. This guy was 6,000, right? This guy will be what? 6,000.
7,000 times 7,200.
And the first one is what?
7,200.
Okay. So we know between this and this is efficiency, right? Which is what? 72 minus what? 66. And that's how much?
600.
600 favorable, right? Good. Then what about this one and this one? Between this and this?
500.
That's the rate variance, right? And that is what? 6,600 minus what? 6,100. That's 500. Also what? Favorable. Meboa. Good. So that gives us what? 1,100 what? Favorable. Which is the total labor cost variance. Okay? And how do you check this? You can just jump straight from here to here and get the total variance. Just take 72 minus 61. Doesn't it give you 1,001?
Yes.
That,
1,100.
yeah. So this is an all-rounded formula. That's why I like this. It's faster too. and it gets all the variance in one than doing formula for each one. When you finish, then you come and add. Do you get it?
Yeah.
Okay. So now if we are filling this one, material, we already had it here, right? Usage was 250 adverse, price was 450 adverse, right? So we come to what? Material variance, right? In our reconciliation statement. Usage was what? 250 adverse, meboa. And then price was what? Material price variance. It was 450 adverse, meboa. Then labor cost. What was the variance? Efficiency, you're saying. Efficiency for labor. 600, and then rate was 500, right? So 600 favorable. Then rate 500. You get it? So as you are working the variances, then you are filling in the reconciliation statement. By the time you are done with all the variances, your reconciliation statement would have been done. Make sense?
Yes, sir.
Now, Isaac, are you getting it now?
Yes, Prof. I'm getting it.
So now let's go to variable overhead variance. The same way, my format will not change. Overheads and labor use the same hours because yesterday I told you, if I'm sitting in this office and then from morning to 5, I sit here, I use the light here, right? I consume the rent. I use the fan. It's the same hours. No be so. If I go home and I lock the office and close everything down, what happens? The overheads also stop running. True or false? So in exam, variable overhead, the hours are still the labor hours that were used. Make sense? So all overheads use labor hours. That's ICA's assumption. ICA always makes management accounting simple for you. And other jurisdictions, they bring machine hours and tell you that variable overheads are absorbed based on machine hour. It means that you are not going to use these 2 hours that are given for the labor. You are going to search for machine hours in the question and use it. But here it's labor hours all the time. But be wary, careful. So here the same way, I'm going to put down what? My standard hour by what? Standard rate, right? Actual hour by what? Standard rate. And then actual hour by what? Actual rate. Do you guys get it? So here is always actual cost. You guys know that. So what's the actual cost for variable overhead? Actual. Give me the figure. Now you'll be the ones giving me the figures. I won't pick. 4,500. That means actual hour times actual rate gave us 4,500, right? That means that actual hour is the same as the labor hour. That means 1,100 actual hours were used as some particular actual rate to generate us this 4,500. Does it make sense? Does it make sense?
Yes, please.
Okay. What was the actual hours used for labor? It's the same use for overheads. 1,001, right? 1,100 hours. Okay. Was used at some actual rate to give us the 4,500. What's the standard hours used? Variable overhead. What's the standard hours?
2 hours by
So as
1,100.
most questions, these 2 hours will not be there. So how would you know it is 2 hours? I just taught you.
From the labor.
Yes, from the labor, right? Because they use the same as the labor hour. So if this place, they just say 4 per hour, you know that, okay, it was the 2 hours by the 4. They get it because they use labor hour. Okay, good. So that means standard hour was what? 2 hours. But what was the standard rate? What have I written by standard rate? OAR. So it means that most of the time, if you go to the exam, they will not give you the standard rate. You are the one supposed to calculate it. You use OAR. So this is what you are going to say. You are going to say your standard rate is going to be my total budgeted what? Variable overhead over my total budgeted what? Labor hours. Then you are going to find what the standard rate is. The same way, if you want standard rate for fixed overhead, it will become total budgeted fixed overhead over total budgeted labor hours. Then you do the calculation, come and get it and put it here. So when you cost in enya, you always have a problem with variance. But does it make sense? Is it clear? So this one, we
Yes,
know
sir.
that our standard rate was what? For overheads. It was $4,
series.
right? So we just repeat $4 here. Okay. But these 2 hours, we always
So,
multiply by what?
1,100.
No. 2 hours where we multiply by what?
The
Actual hours.
actual
Not
unit
actual hours, actual units produced.
produced.
This is what it means. We are saying that TABBO, ENTA, if 2 hours was for only 1 unit, at the end of the day, we produce 600 units. 600 units, no, hours saying,
Okay.
no.
Okay.
So if 2 hours, 1 unit, 600, saying, if more, let's divide. So you are literally saying that, okay, this will give us what? 600 out of 1 times 2 hours. And that's what you are doing here. Is it clear?
Good.
Is it clear?
Yes, sir.
We're here for 1 pay, but we need for all the units that were actually produced and sold. So this one, we produce 600 units. You see, all of them, material or labor, overhead, all of them. Standard is always of actual production. Please don't forget actual production. I didn't say actual hours. Actual production, because it's the hours that will be multiplied by the production to get the total hours. Clear? So that gives us what? 26. That's 12,002. It means that we expected to use 1,200 units, but we ended up using 1,001. Do you get it? We expected to use 1,002, but we ended up using what? 1,001. Do you get it? So in that case, by 4, 1,002 by 4, you're being just saying 12, 4. That's 4,800.
4,800. Yeah.
And this one, 1,001 by 4. 4,000.
4,100.
Also, okay. So between this and this, we have what? Efficiency. True or false?
Yeah, true.
So 4,800 minus 4,400. What's our efficiency variance?
400.
400 what? Favorable, right? No, be so.
Yeah.
Let's and this. We have what? Expenditure or rate. Expenditure variance. Because these are expenses. It's between 4,400 and what? 4,000 what? 500. No, be so. And that is what? 100 what? Adverse.
Adverse.
So what's our total variable overhead variance?
300 favorable.
300 favorable. Tell me the gospel truth. This thing, is it difficult?
So, Prof,
Yes, boss.
let me get something clear. Just as you've done the presentation on the face of the account like this, the same way we're also going to do, not in any form.
Is it the same way?
And just as you have the display,
Yeah.
same way we are to follow suit.
Of course. Why not? Did it make sense?
Yeah.
Yeah. This method is straightforward, though. You don't have to think this thing is adverse or just subtract a negative by adverse, a positive. That's all. Are you getting it now? That's why I said if I'm teaching you, you have to unlearn whatever you were taught. Otherwise, you mix things up. Just go straight. Obi now Obi ka baby.
Me say you plan the education in okra.
Do you get it? So you realize that this method, it doesn't matter what you are doing, it's the same. Share. You starting from the top. SQSP, AQSP, AQAP, SHSR, AHSR, AHAR. Like that. The same thing. SHSR, AHSR, AHAR. The same thing. It wouldn't change. The same. The only one that will change is fixed overhead, because fixed overhead is stubborn. But we'll still use the same thing. I'll just teach you to slot in just one line or something new. And okay, so let's go and fill in our sheet again. Have we gotten a new variance? What variance have we calculated now?
Variable efficiency and expenditure.
It was 400 and adverse, right? 400 and 100 adverse. So when we come to variable overhead on our reconciliation statement, we say variable overhead, right? Then we say what? Efficiency. How much was it? Was 400 favorable.
Efficiency favorable.
Then expenditure was what?
100.
100 adverse, right?
Ad-
Okay. Now we go to fixed overhead variance. This is why I want you to all to pay attention. So with fixed overhead, we still put down, because fixed overhead is made up of volume and what? Volume and what? Expenditure, right?
Okay.
And this expenditure is volume is also broken into two. One is what? Efficiency, because we use labor hours, right? Then two is capacity. Maybe we might have used different capacity, different production capacities. So this is it, right? Now, fixed overhead variance, all you have to do is still start with your standard hour times standard rate that we learned, right?
Mm.
This must change. It becomes what? Actual hour times what? Standard rate. Meboa. Then you go this way. Then that gives you what? Actual hour times what? Actual rate. Are you following? But between
Mhm.
this one and this one, just slot in something new, which is just budgeted hour times standard rate. That is all. So you see, it didn't change. It's the same thing. But on a normal case, you would have done 5 variances for fixed overhead in a normal typical question. But my method gives you all the 5 without thinking. Do you get it?
Okay. Okay.
Yeah, I like to make things simple for you. You don't think, you just do. That's all. So you do all the ones that you do, which is 1, 2, and 3, right? Then you come and slot in this one here. Makes sense. Remember, this is where before what you were asking, Shadio. We know standard hour. We take our standard quantity per unit. Then we multiply by actual units produced. Mokai.
Mm.
But budgeted hour, no? What are we going to do? We take the standard quantity per unit. But here we multiply by what? Budgeted units produced.
Mhm.
You get the difference? Indeed,
Mm.
by saying we should multiply by the 500, but to get standard, we multiply by the actual, which is the 600 that we produced.
Okay.
Does it make sense to everyone?
Okay.
So always standard.
Yes.
I told you the very first day we met, I said standard gives birth to 2 things, and you were singing it with me. It can give birth to the budgeted and can give birth to the standard. Mokai, after
Yeah.
some days you have forgotten. I beg you. These things, hardly do people talk about it because they assume you know it. But I know students do not know it. That's why I hate it again. Okay, good. Now, through these same fixed overhead variances, I'll teach you how to use it to generate control ratios. You don't have to think. That's all. Between this and this, what is the differentiating factor? Rate and rate are the same, meboa.
Mm.
But the difference is in what? The
Hours.
what?
Um,
The hours. So this is efficiency. Are you following?
mm.
Now, when you come here, rate and rate are also the same, but the difference is in what? The hours. But this hours is between actual hours and budgeted hours. That means the capacity you use to work or the capacity to absorb might have been different, right? So what we budgeted might have been different from what we actually did. So that is your capacity to absorb, and that is your capacity variance. Then between this and this, as usual, is your normal price. Okay? When you get efficiency and capacity, when you add them, you should get volume. Then when I come and add price, I should get my total fixed overhead variance. How many variances do you have in all? Count. 1,
1, 2, 3.
2, 3, 4, and 5. All in one for you. Should we do this question? Should we do it?
Yes.
Okay.
Yes. Please.
So now, let's see. What is the pro forma? What do we put down first? Let's change the color more. I'm getting bored of the color. I want something bright. Okay, let's use orange. Okay. So let's go. So fixed overhead variance. Can you see?
Mm.
Can you see?
Yes, Prof.
So we start with what? Standard hour times what? Give me. You rather give me. Let me see if you remember.
Standard
Times
hour, standard rate.
Standard.
Standard rate.
Then what follows?
Actual
actual
hours.
Per hour,
standard rate.
Standard rate.
standard rate.
Then we leave one space, right? Then we write what? Actual hour by what?
Actual rate.
Then we introduce something.
Actual rate.
What do we introduce?
Budget.
Budgeted
By what?
Then
standard rate.
That's all. Now let's just pick the figures. Fixed overhead standard rate now is saying $5 per hour. Meboa. True or false?
mm,
No be
It's
so.
true.
So copy and paste.
Paste.
Also,
paste.
so this one was what? How many hours? It's the same as the labor hour. Mokai. 2 hours. No be so.
Mm,
$5. $5. $5. Right? Good. Now budgeted hour and standard hour, they use the same hours per unit. Mokai. But just that this one we multiply by what? Standard we always multiply by actual unit produced. Wow. And budget we multiply by budgeted unit produced. Mokai.
Yes, sir.
What was the budgeted unit produced?
500.
500 budget. Then standard we multiply by actual, which was 600. Remember?
Yeah.
That's all. Actual hours that was used for labor was what? It's the same for fixed overhead. 1,100 hours. Mokai. That means here was 1,100 hours, but by some rate, okay, gave us what? What's the total cost for fixed overhead?
Sir, I beg. He said the budgeted hours same as the actual hours.
How? How is it the same as actual hours? I don't get what you're saying.
He just mentioned
No,
something
I
like
said this actual hour here, which was 1,001, was
Uh-huh.
multiplied by some rate, which was the actual rate, to get what? Except budgeted hours is the standard quantity per unit, the standard hour per unit multiplied by the budgeted unit. But standard is multiplied by actual units. Get the difference. You see here is by 500, which is budgeted. Here is 600, which was actual. Actual production and sales, 600. Budgeted output and sales, 500. So budget is by budget, standard is by actual. Budget is by budget, standard is by actual. Do you get it?
Yes, sir.
All right. So in that case, 1,001 by some actual rate gave us a total cost for fixed overhead of how much?
5,350.
So this one is 5,300 and what? 50. No be so good. Now 25. That means this one gave us like 1,000, right? 1,000 divided multiplied by 5. 1,000 divided by 2. That's 500. So I add 1 0. That's 5,000. 1,001 by 5. That's what? 5,500, right? 5,500. Then we have what? 1,002. Also by 5.
6,000.
Because it's 1,002 divided by 2, that's 600, add 1 0. Okay, so that is it. So now that we have this, we know between this and this, we have what?
Efficiency.
The efficiency is 6,000 minus what?
5,500.
Minus 5,500. What do you get?
500 favorable.
500 favorable. Then between this and this, we have what?
Capacity.
Capacity, which is 5,500 minus what? 5,000, which is the same 500 favorable again. Now, efficiency plus capacity gives us what? Volume, which will be what? 1,000 what? Favorable. It's the same as jumping straight from 6,000 and diving here. So 6,000 minus 5,000 is not 1,000. This format, you can move from everywhere. If you want the total variance, you can just move from 6,000 to 5,350. The difference will give you the total. It doesn't really matter. But here we are moving from here to here, right? Which is price, expenditure, sorry. So expenditure becomes what? That's 5,000 minus what? 5,3 what? 50. And that gives us what?
350 adverse.
350 adverse, right? So it means that our total was what? Total fixed overhead.
650. 650.
Okay, that is 650 what? Favorable.
Favorable.
Okay, jump and let's see. 6,000 minus 5,350. Check and see from top to bottom. 6,000 minus 5,350. Ibenya saying? Ibenya saying?
650.
The same way volume. Jump from here to here. 6,000 minus what? 5,000. And Usubenya saying? Is it not the same thousand? So it doesn't matter. Anywhere you jump, you can get. That's why I like this.
650.
Yeah.
So, Prof, does it mean if you jump and there are variation, that means your answer is wrong?
No, it won't be wrong. It will always be correct. Because it's a step by step.
So in practice, I say what you say who was 5 minutes video last episode, I will check his answers near correct.
Check here.
That's I will check and I say and I'm far. And say
There's no way I am far. Because so far as you can add this and get volume, that means when you move from 6,000 to 5,000, it will be the same. There's no way there will be a variation. Unless maybe it's a typo. Okay. Even in exam, if you realize, they just move on. They mark the individual entries, so don't worry. Is it clear? Now, you know that this method, we used it because we were absorbing. True or false? There was fixed overhead per unit. What we were doing marginal costing. Marginal costing, do we absorb?
No.
So under marginal costing, there's only one fixed overhead variance. It's the expenditure variance. So marginal costing, there's only one what? Fixed overhead what? Variance. And that is what?
Expenditure.
The expenditure variance. So under marginal costing, what you do is that you take what? Your budgeted hour by your standard rate and compare to your actual hour at your actual rate. That is all. Okay. Do you get it? Are we clear? So under marginal costing, the only fixed overhead variance we have is what? The only fixed overhead variance we have is what? Expenditure, because we don't absorb, right? Okay, good. Now that you guys have understood this, did our method change? Did our method? No, it didn't change, right? Okay. Now we've gotten these variances. Let's fill them in for fixed overhead. Okay, so let's come here and say fixed overhead variance, right? Fixed overhead variance. Capacity was what? 500 favorable, right? Efficiency was what? 500 favorable, right? Then we had what? Expenditure. Expenditure, now saying 350 adverse, right? No, be so. Yeah. So at the end of the day, we add all our favorable variances and all the adverse variances into favorable variances. So adding in there saying 1,000 plus 600 plus 500 plus 400 plus 1,000.
3,500.
That's 3,500, right? Okay. Then all the adverse variances, we put them together. 1,002 plus 250 plus 450 plus 100 plus
900.
That's 2,000, right?
350.
So if I put them together, what's the total sum? That's 3,500 minus 2,350. That's 11 what? 1150. Into comparing 1150 to 5,000, it was a positive 1150. So 5,000 plus 1150 should give us our actual profit. So in exam, because I know some of my variances may not be accurate, I just go and copy the actual profit and come and put it here. Okay, so 1150 plus the 5,000 at the top, I get 6,150 as my actual profit. So we can check and see if it is true. You can check and see if our actual profit was actually 650, 6150. Yeah, sure, dear. Sales was 28, right? And this was the total cost. Meboa, let's add them and see and subtract from the sales and see if truly we get the 6150. So 6700 plus 61 plus 45 plus 5350. We get 22,650. So 28,800 minus that.
Takes 150.
So in exam, I would have calculated this number. The variance is now correct when you're correct too. Menya mark. I'll put 6150 and find the difference between that and the 5,000. Now me share her. Into a best my calculated variances no na me to her. But meanwhile, some of my variances may be wrong. I don't know, but I'll get the full mark. Strategy.
But yesterday, the examiner will say that.
Yes, they will see, but you still get the mark for it. They always, in the marking scheme, we always give marks for that. So no matter how you get it, you still get the mark. Don't worry about that. We are human. Always, there's an oversight in things like that. I've marked for several times, so I know. So I always use that loopholes to teach my students. What's that? Usually, Shadio, you know, if you are comparing two things, right, and you are looking at the marking scheme, usually once you work and then you look here and the thing is there, because of your photographic reflex, you'll be tempted to give the person the mark here. Do you know that? Because that's exactly how it was presented. 150, it happens all the time. It's human psychology.
On the calculator now, calculator.
He's just looking whether the figures are there. It's only one in a million, but sometimes they'll give it to you. It's just some 0.5 marks. Whether you get it or you don't, you just do it. It saves you. How was basic variances? Made sense. You see, they didn't ask us for reconciliation, but I still reconciled and it balanced. Didn't you see?
Yeah.
Okay. Okay. So let's assess the performance of the various managers. The sales manager or the sales and marketing manager, did he do well overall?
No.
No. So we can criticize him, right? What about material? Which manager is in charge of material?
Procurement.
Procurement is material price, but production is material usage. Because production manager no use in the process, but procurement manager neto materials ne buy. Makes sense.
Yeah.
All right, good. What about labor cost variance? Which manager is in charge?
Production.
Production. What about labor rate?
HR.
It's production
HR.
or HR. Some companies' production department sets the rate for labor. Some companies to its HR who sets the rate for the labor, the daily workers, right? Yeah, the foreman does that. So it's part of production. What about variable overhead? Both of them is the production manager, right? Good.
Yeah.
So you criticize them. You say performance of the production manager. Production manager didn't do well overall because the total production variances are this much, and you think that management should put in the following. This might be due to, remember, these things might change because one, labor costs are higher on the market. True or false? Two, inflation. Three, the CD depreciating against the dollar. Four, high cost of raw material. Five, expensive or inability of the procurement manager to negotiate better prices. Five, insufficiency of what? Wrong budgeting. I mean, you can say anything. Think about it. You get so many things to say. Management accounting, it is theory, but the calculations no support theory, no. But people think it's a calculation paper, and theory is just there. No, they are not learned in isolation. They are learned together. So basic variances, are we okay? Can we try another difficult one?
Yes, yes.
This is the idea. Gradually, you are getting there, right? Okay, good. Shadia. You see, possible reasons for the variance, efficiency variance, motivation of employees, right? If they are motivated, they'll produce good things. Quality of the employees you brought, the quality of the materials. Let's say if you buy fake materials or materials which wastes time, won't our efficiency be diminished? True or false?
True.
Because if I'm supposed to spend 5 hours working on this material, no material no enya papa, so me waste the time. Because there will be a lot of wastage, I will waste time. True or false? What about quality of the employees? Me kofa kwanche employee bi be ye adwuma na metua no lower. Can he work efficiently? Highly motivated staff are more efficient. Highly skilled staff are more efficient. These are techniques you can use to interpret the variances you calculate. Variances are not just calculated, they can be interpreted. It's still ratio analysis that you're doing, but with actual, your friend is saying,
Result.
you get it. Now, you see the